Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
Coming up on the show today, Ross Clark from chartsandmarkets.com runs down the major markets. He says the NASDAQ and S&P are off their all-time highs, but the Russell continues to set records. Ross takes a look at gold, silver, crude, the U.S. and Canadian dollars, and Bitcoin, which has run into a rough patch. Publisher of the trendletter.com, Martin Straith, comments on what some are calling this week's chip wreck, and also on what's driving Bitcoin's plunge in value and the struggles gold and silver have been having lately. He also looks at the U.S. and Canadian dollars. Editor of the Straith.Energy Report.ca, Josef Schachter, drills deep into the energy sector. He doesn't believe low oil prices will last for long, and he thinks LNG is a good long-term bet. He also has details on his upcoming energy conference this October in Calgary. Author of the second edition of the book, When the Bubble Bursts, Surviving the Canadian Real Estate Crash, Hilliard MacBeth, joins us from Edmonton. He looks at declining real estate values in Toronto and Vancouver and expresses shock over the BC federal government deal to bail out real estate developers who can't sell thousands of undersized condos. Now, let's get into the show. My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on X at Charts by Ross. Welcome back to This Week in Money.
Good to be with you, Jim.
How would you describe what happened on the stock markets this week?
Well, we're getting the mixed bag here. The S&P and the NASDAQ put in their highs a couple of weeks ago now, and they've not been able to come to new upside action. They do have good support that's been tested a couple of times, but the leadership has clearly gone over to the smaller caps. The Russell is at all-time highs this week, and if we take a look at the other areas, the biotechs, you look at BBH or NBI, which are the ETFs there. Those are into new highs for the year and on the run. Also, the bankers, the JP Morgan, Citigroup, and the BKX index doing exceptionally well right here. So this is a market of transition. And our modeling as far as the global M2 money supply is concerned would suggest that there's maybe another week or so on the upside, giving us upside bias. But as we move towards August, I think things will pull back, and we'll see whether the underlying supports hold in here. It's pretty much a flip of the coin. I would say that having tested the 50-day moving averages, that the next break of significance, once we roll over in July, could be a good 10% below where we are right now.
What's happening with the crude market?
$69 crude, a long way from 119, and that one has had just a poor week all week long here. Not much in the way of a bounce. There we are. Even a week ago today when we were talking, we were at $90, and now we're at 69 and change. Some of the oscillators are starting to get a little oversold, and we're back to levels that we haven't seen since the Americans attacked Iran. So I would suggest that probably going to see a washout here, and a reasonable low in the low 60s will become a tradable event. I would suggest to subscribers that they take a look at the stocks themselves. There's going to be some great opportunities here. The XLE, the XEG, the USO, those ETFs will provide, I think, pretty good bounces, and because of the extent of the decline, these will provide some decent returns on the bounce.
What's going on with gold and silver?
The rare signals here. The gold market put in a capitulation low this week, a couple of days ago. That is the fourth one in this century. You've got to go back to 1997 to see breaks that were of this significance. This is when we get both our short-term summation index and the exhaustion index, which is intermediate in scope. When they simultaneously get oversold, then that's what we would deem to be a capitulation. So we've had this week. The silver market has put it in as well, and platinum. So when you look at the whole precious metals complex, it is really due for a decent bounce in here. And that pretty much goes part and parcel with the fact that we had some weekly signals kicking up a week or two ago saying that we were approaching a low. And on the other side of the coin, the U.S. dollar index got up into pretty much high atmosphere in terms of pricing. We were up to 101.5 on the index, and that one had weekly signals here 2 weeks ago, and all it needed was a reversal. And this week we saw an upside exhaustion. At the same time, we were seeing the other side of the coin on gold and silver. And we take a look at the currencies. The euro put in a downside capitulation. The Canadian dollar downside capitulation. So it looks as though this is going to be a key reversal point when we look back on it. The potentials for all of these are maybe a few week retracement rallies at minimum, and we'll see if they can do much more than that. But I wouldn't be at all surprised.
Bitcoin plunging from around $125,000 from a high in October down to the 60s right now. What's the story there?
Yeah, well, when in February when we got down to the 60s, that was one of those capitulation points, and we got really nice retracement rally up to 82,000. We thought it could do a little better than that 82,000, but it rolled over there. We are now right back down through the lows at 59,600 as we talk right now, and it's at this point it's potentially a double bottom, but I don't think the low's in place. I think we've got more on the downside. That was a pretty decent rally, 20,000 on the upside. So, maybe we're going to have another 20,000 below the supporting level here at 60,000. And nothing would surprise me in Bitcoin. That one, we just wait for signals to kick up and then take advantage of them.
Anything going on with copper?
Copper market has been sort of the resilient one within the whole metals complex, and right now we're sitting pretty steadily here around 620. I've got some short-term oversold signals in here. Also seeing that in some of the related stocks. So it would suggest that copper probably holds in this $6 range and has some upside potential.
Ross, thank you so much for being on This Week in Money.
Good to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. You can find him on X at Charts by Ross. Coming up, Martin Straith, next on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Martin Straith, founder of Trend News online at thetrendletter.com. He's speaking to us from Coquitlam, BC, which is just east of Vancouver. Welcome back to This Week in Money.
Oh, Jim, thank you. Always a pleasure.
Previously, when you were on, you said once the Strait of Hormuz reopened, that WTI oil would drop back below $80 to the low 70s and even into the high $60 range. Since the signing of the MOU between the U.S. and Iran, the WTI price has been following your forecast precisely as it hit $70 this week. Is it time to buy?
Yeah, it's been quite a move here. I mean, you think about it, back on, February 17th, I think oil was trading about $67, $68. And then the next day, Israel and the U.S. started bombing Iran. We saw oil spike up to, almost $120, I think it was by mid-March, March 9th, I think it was actually. And since then, our model projected three key support levels, $88, $79 and $70. And today, quick look here. So today, oil's trading at $69.40. So right back where it was before, the day before the war started. Now, obviously, the key drivers of the decline have been the Strait of Hormuz reopening and that 60-day U.S. sanction waiver, which is allowing Iranian oil to get back into the market. So oil is now flowing through the strait, and the volumes are continuing to rise. I'm seeing the numbers here; they're getting not that far off what pre-war numbers look like. So now, of course, we see if we see the ceasefire broken and tensions rise again, if that happens, it certainly seems like it could happen again. But for now, there's a lot of optimism. And remember, this is a 60-day trial. It's not a permanent resolution, at least not yet. So we have seen the systematic drop that we were calling for. So the main route through the Strait of Hormuz, it still has mines that need to be removed. So that basically the main route is still closed. So ships have been using two alternative routes. The first one is an eastbound route hugging the Oman coast. This is the one the U.S. supports. Iran does not approve of this route, and they're calling it dangerous and prohibitive. And I think they actually were firing on one of the ships today that was using that route. The second alternate route is the one supported by Iran's Navy. That's the one that runs north and south of the Lurak Island. So far, we've got the 60-day memorandum of understanding. It's remained in effect. It's allowing oil to flow. And obviously, so that's keeping the prices lower. So something for investors to remember here, though. During the Iran conflict and when the strait was closed, governments around the world drew heavily on their oil reserves to cushion the blow of surging oil prices and to keep the fuel, flowing for the customers, consumers, and the industry. I mean, the U.S. Strategic Petroleum Reserve was already at historic low levels before the conflict. Remember that Biden had been using that to try and keep gas prices down. So it had been drawn down significantly in the prior years, and obviously with the recent crisis depleted it much further. So governments don't leave these reserves empty. They have a strategic and national security obligation, to maintain minimum stockpile levels. So when we see oil falling into the $65 to $70 range, those same governments become buyers, methodically starting to refill the reserves at prices they consider attractive. So this government restocking buying doesn't, it's not going to move the market violently, but it will create this consistent and predictable bid underneath the market. So it's essentially a government-sponsored price floor. So that's why we're expecting that we don't think we're going to see oil, at least at this particular juncture, to drop below maybe 65. The lower oil falls, the more attractive the restocking becomes, which is exactly why sharp, sustained moves below 70 tend to find support. So ironically, the very countries that release reserves to fight the high prices become the buyers that will prevent prices from collapsing too far. So as I say, right now, oil is at $69.30. Our model's initial target low was $65. And obviously, we're getting very close to that. We're only, we're within $3 of that. So we'll be sending an update on this in our Sunday's issue of the Trend Letter. But we are looking at, we're getting very close to a buying signal.
U.S. inflation came in hotter than expected this week, hitting a 3-year high, and the new Fed chair, Kevin Warsh, is already sounding hawkish. But is the Fed potentially fighting the wrong war here? Because if the Middle East tensions ease and energy prices keep falling, doesn't the inflation problem largely solve itself?
Yeah, well, I think, that is the question the Fed should be asking itself right now. Obviously the inflation story of the past few years has been very specific, had a specific driver, energy. Now, the war in the Middle East obviously pushed oil prices up, and energy feeds into the cost of virtually everything. We're talking, transportation, manufacturing, food production. It all runs on energy. So when energy becomes expensive, a higher inflation is inevitable. But look at what's happening right now. There's a potential peace framework emerging in the Middle East. We just discussed the Strait of Hormuz is reopening. Oil's already fallen sharply, trading right at its pre-war levels. So if that holds, well, the biggest structural driver of the inflation is starting to unwind on its own without the Fed needing to do anything. So, as you say, that puts Kevin Warsh in a pretty tricky position here. If he raises rates aggressively to fight inflation that's already in the process of cooling, then he risks over-tightening into a slowdown that wasn't necessary. Now, the bond market may be already sniffing this out here. The 10-year Treasury, the U.S. 10-year yield, has been quietly slipping from the 4.7% high it had in mid-May, and today we're looking here, 4.37%. And that's even as the Fed sounds hawkish. So, the Fed's talking, raising rates, yet the bond market's saying, I don't think so. So that's the market saying it's not entirely convinced inflation is as persistent as the headline suggests. And, to be honest, the honest take here is if peace holds and energy stays cheap, well, the Fed's inflation problem may be significantly smaller than the inflation numbers we saw. I think the worst outcome for the Fed would be that if it raises rates in July based on May's data, just as the underlying cause of inflation is already fading. So, they're always looking at, previous data, and you got to be aware that the reason that data was so inflated was because of the high oil prices. I think sometimes the most dangerous thing a central bank can do is try to win a battle that's already starting to win without them. Now, one thing, though, that I've said many times is that much of the inflation is being driven by government overspending, and there's nothing the Fed or any other central bank can do about that. I don't think a 25 or 50 basis point hike or cut is going to change long-term bond rates much.
This week we saw semiconductor stocks get absolutely hammered midweek, chip wreck, as you might say. Micron was down 11% in a single session. The Philadelphia Semi Index dropping nearly 8%. And yet by Wednesday night, Micron reported what might be the most stunning earnings in the company's history. So what does this tell us about what the market is pricing AI at right now? And are we in a rational market, or is this pure emotion and momentum?
Yeah, well, and I guess first we should sort of take a step back here, because I think when most people hear Micron makes memory chips, they don't immediately connect that to artificial intelligence. So to clear that up, so every time you interact with an AI application, so ChatGPT or Claude, and you ask it a question, there's a massive data center somewhere running that request. So inside that data center are racks of NVIDIA GPUs. So those are the processors doing the actual AI computation. But those GPUs can't work alone. They need memory sitting right next to them, feeding them the data fast enough to keep up. And that memory is called high bandwidth memory. And right now, Micron is one of only 3 major companies in the world that can make it. The other 2 are the South Korea's SK Hynix and Samsung. So Micron's entire 2026 supply of that high bandwidth memory is already sold out under fixed price contracts. So you can't build more artificial intelligence this year with Micron memory because it doesn't exist yet. That's why Micron's CEO disclosed at the earnings call that the company can at best only fill 50 to 65% of the customer demand in the medium term. So that's a structural supply deficit that continues to amplify pricing power. So to get back to your question, what's driving the AI sector this week? Well, it shows exactly how sentiment can move stocks, and Micron's, would be like Exhibit A. So as you say, on Tuesday, the narrative was AI spending is getting reckless. Hyperscalers were loading up on debt. The Fed was turning more hawkish. South Korea chip index collapsed, I think it was 10%. And with most of those declines were driven by fears about the high-flying semiconductors. And then Micron specifically on that day, it dropped 11% on that day, purely on sentiment. There was no new fundamental information about the company, pure sentiment. Then, as you say, on Wednesday, the actual numbers arrived. And they weren't just good, they were stunning. So you had revenue, profit, forward guidance. They all came dramatically ahead of what Wall Street expected. So on top of that, Micron announced long-term supply agreements and major customers locking in billions in guaranteed revenue for years ahead. So that's not a cyclical chip company riding a wave anymore. That's a business with a structural floor underneath it. So the stock surged after hours, erasing Tuesday's entire loss overnight. So rational market or pure emotion? To me, you've got both running in parallel here. Tuesday was emotion. Wednesday was rational. So the fundamentals showed up and they did the talking. So the lesson for any investor, to me, is simple. In a momentum-driven market, price and value can disconnect violently within a matter of hours. So the trend line on the SOXX semiconductor ETF, it keeps holding because the earnings keep delivering. I'm looking at a chart of that right now, and it's just parabolic. So that risk, the risk, of course, here is the day that the earnings do not keep delivering, and that day will come.
SpaceX went public last Friday at $135 a share. Everyone was excited. It went up to $225 approximately, and then it fell down to about $155. Should everyday investors actually be buying now, or are they walking into a trap?
Well, that's certainly the question to ask, because, the excitement is real, but so is the risk. People need to understand that before SpaceX ever traded on the public exchange, that just started on last Friday, you had massive institutional players. So we're talking, Google, Fidelity, large venture capital funds. They were allowed to buy private shares years ago, long before, everyday investors were given any opportunity to invest. So those are sophisticated, well-connected organizations, well-funded, and they got access to SpaceX at its earliest and cheapest stages. And that's a privilege that was completely closed off to the ordinary retail investor. Now, and the people today, if you're buying SpaceX today, you're going to end up buying it from those very people that bought the stock. So if you're buying it today at $155, the people selling you that stock are going to be these insider buyers. And you have to understand that they bought for as little as $4 to $6 a share, and they're sitting on gains of up to 3,700%. So think about that. If you're one of these big institutional players, and say you bought $10 million investment at $4, that that $10 million investment today would be worth $387 million. So a mandatory lockup period has prevented these institutional players from selling since the IPO has been issued, but that window opens up in late July, I think it is, and early August. And when it does, that could be a flood of profit taking that drives the price down dramatically. So if you're the average person and you're buying SpaceX today at $155, you could see that investment drop significantly while those institutional insiders cash in. So that said, the long-term story is generally still compelling. Starlink itself is a recurring subscription revenue business with millions of subscribers across, hundreds of countries. And that alone could be worth more than the entire rocket business. But I think the thing that most people aren't saying is Starlink is not operating in a vacuum anymore. You've got Amazon. They've committed $10 billion to its competing satellite internet service. It's called LEO, and it's integrating directly with their AWS infrastructure, and that makes it a very attractive enterprise for government and enterprise customers. And then here in Canada, we've got Telsat, Lightspeed constellation. So that's being built by a company called MDA Space. Now, just so people know, MDA Space is a position we hold in our trend letter portfolio. And the case for it is very interesting. Well, everybody's paying top dollar for SpaceX at $155. MDA is a much smaller company, publicly traded on the TSX, and it is building the next generation of satellite infrastructure. So if Lightspeed succeeds, the upside to MDA's current valuation would be considerably more attractive than, buying SpaceX, which is already priced for world domination. Elon Musk is obviously a big reason many investors are willing to pay the premium for SpaceX, but he's also juggling Tesla, XAI and X. So that's making SpaceX, heavily dependent on one person, and that's a risk that, to me, deserves a lot more attention than it's getting. So the smartest investment news to me, an idea for most newer investors right now, would be patience. Let the lockup expiry day pay out, and see where SpaceX settles. And then ask yourself then whether there's a smarter way to get exposure to the space economy without paying the most expensive price. SpaceX is priced to perfection here, and because SpaceX, the company, may well be iconic, but buying at the wrong moment from people who paid a fraction of what you're paying, that could cost you a lot. So with SpaceX, the company's real, the hype is real, but the risk is also very real right now. And I think patience and looking for the broader economy, the space economy, might serve investors better than chasing the headline stock.
Gold has pulled back sharply from its January highs, and some are calling the 3-year bull market over. But with inflation staying sticky, a hawkish Fed, and geopolitical uncertainty rising globally, is a sell-off in gold an opportunity or a warning sign?
Well, I always say, money goes where it's treated the best. So the bear case for gold is pretty straightforward. Higher rates have been a headwind. Gold doesn't pay a yield, so when rates rise, the opportunity cost of holding gold goes up. That's a real pressure and explains, a big part of the pullback in gold right now. But the bull case for gold to me is much more interesting. You think about what's happening simultaneously. You got sticky inflation. The Fed may raise rates further. Geopolitical tensions escalating in Europe, the Middle East, and Asia. And you got capital looking for somewhere safe to go. So historically, those are exactly the conditions that drive gold higher, not lower. So there's also an unusual dynamic happening here. Normally, gold and the U.S. dollar move in opposite directions. So when the dollar strengthens, gold typically weakens. But we've seen signs and periods, most recently we saw 2023 and 2024, where they both rose together. And that happens when global uncertainty is so elevated and investors are fleeing to every safe haven simultaneously, regardless of the typical relationships. So the contrarian read on this week's pullback is that it is likely setting up the next big leg higher. Markets work like a pendulum. The further they swing in one direction, the more energy that builds for the reversal. So a sharp pullback in gold, which we've been seeing, against a backdrop of rising global instability, that to me creates exactly the kind of compressed spring effect that we like to see on a big rally. So the honest answer for your question there was, if you believe inflation stays elevated and geopolitical risk keeps rising and global capital gets increasingly nervous about what's going on in Europe and Asia, gold bull's run is pausing, likely not ending. But if the Fed successfully tames inflation and the world stabilizes, the 3-year run may be over for now. But for me, right now, the weight of evidence favors the pause, not the ending. Today we've got gold's up here. What we got? It's up about $65. So at 4,092, critical levels. We've got 39.30 is major support. Breaking that level would be technically bearish. But note here on Wednesday, it hit 39.59. So, we're talking, $30 from that low. So the low might be in right now. 3,500 is the ultimate floor for us. That's the correction low that has to hold in order for the bear case to be intact. On the other side, 4,600, that's near-term resistance. The key resistance would be about 48.83. That's the level that must be broken to really signal that the recovery is going to gain some real momentum here. And of course, 54.25, that's the all-time high, and that remains the ultimate target if we're going to get, full traction here. And bigger picture, long-term uptrend from, October 23 low is still intact. The current correction, essentially to me, is a healthy pullback within that larger bull market. As long as 39.30 and 39 or 3,500 hold. And then, in the very big picture, we're very bullish gold. You've got the debasement trade. You've got global debt is sitting around 350 trillion. U.S. debt's now over 39 trillion. I mean, that equals about 115,000 per citizen in the U.S. Canada and most of the G20 countries are all racking up similar debts. So when these governments need to print money to pay off their debt, that destroys the purchasing power of each of those currencies. So while we did see some central banks like Turkey and Russia sell some of their gold due to the high energy prices, we expect most of the central banks are going to resume the gold buying. Central bank holdings have now surpassed U.S. dollar or U.S. treasuries in reserve share for the first time in I think, 30 to 35 years. So, in 2020, China had $1.08 trillion in U.S. treasuries. Today, they've only got about $690 billion. So again, we're watching next week or so, but I think we're very, very close to a buying opportunity for gold. And actually, I think we're ready to dip our toes in again, and we'll be issuing some information for our subscribers in Sunday's trend letter.
In your trend letter and here on the show, you've been warning listeners for 2 months that silver could reset all the way back to $50. Most people thought it was crazy when it was trading near 90. Now we're close to 50. What happens if it gets there?
Yeah, with silver, the pattern I've been highlighting the last few times I've been on here is it's still intact. So right now we're just sitting right now about $57. So we're getting pretty darn close to that $50 to $52 key support. And again, as you say, it's played out almost exactly as we've warned. Silver spiked to near 120 in February. That parabolic move. We said at the time, we said at the World Outlet Conference, that is going to need a serious reset. We flagged 70 to 72 as the first test. Then 65 is a line in the sand. Both have been broken. And like I say, we're sitting at about 57 right now. So the $50 to $52 zone we point to is very much in play. It's not a random number. That's where silver spent months consolidating before that big run up to $120. Markets tend to return to where real buyers previously stepped in, and that's exactly the level that represents. So remember, silver is a unique animal. It's part precious metal and it's part industrial commodity. So when we see industrial demand soften and safe haven buying fade at the same time, well, you get moves like this. They're fast and they're brutal. But here's the other side. A reset to 50 or 52, that's going to be painful for anybody who chased that February spike. But for the patient investors, those who've been waiting, the ones who've been listening to what we've been talking about, that's potentially one of the most compelling entry points I think you're going to see in years. So the $50, $52 zone is where we find out is this a correction or is it something more serious? If we get $52 silver, we're likely going to be sending out a buy alert to our subscribers.
What's happening with the U.S. and Canadian dollars?
Well, the most important thing to understand about currencies is you're never judging one in isolation. You're always judging it in relative to something else. So it's not about whether the U.S. dollar is good. It's whether it's better or worse than alternatives. And right now, the alternatives aren't exactly inspiring confidence here. I always like to say the U.S. dollar to me it's like the least ugly house on the block. Yes, the U.S. dollar is being debased. Deficits are enormous. Debt is piling up. The money supply has expanded dramatically. So nobody's arguing that. But look around the neighborhood. I mean, look at all these other houses. All these major countries are doing exactly the same thing with their currencies. They're debasing them. So the U.S. dollar spent months being rejected at about the 100 point, I think it's about 0.5 level. But this week, the dollar broke above that quite convincingly, riding a really clean ascending trend line all the way from the February low. And again, as I was mentioning earlier, we do a lot of charts in our publications, and because to me, chart just is so much easier for investors to understand what's going on. So this is a technically significant breakout. Now, on the other side, we got the relative strength for the U.S. dollar is sitting right now. We're looking at what here? At about 68. Now, 70 is considered technically overbought. So we've seen a bit of a pullback here today, so that makes sense. Now, with the Canadian dollar, the chart is actually very striking. The loonie has broken out hard from its ascending trend line, and the key was at 70.78 support level. It's now sitting at, 70.47. So that is now below that support, and it's at a one-year low. Now, here's the real key, though. On Wednesday, the relative strength for the Canadian dollar was at 12.5. That is mind-boggling low. I mean, to put that in perspective, 30 is considered oversold. So Canadian dollar was at 12.5. That is almost unheard of. So today, the RSI is now up to 2071. The Canadian dollar is starting to rally a bit. And this has been incredibly oversold. So certainly a bounce here would be expected. The Canadian dollar has been pressured by a hawkish Fed, softer Canadian economic data, falling commodity prices. So, the Bank of Canada rate is right now at 2.25%. The Fed rate is at 3.75%. So the Fed rate is 1.5% premium to the Canadian. And the Fed is talking that they may be hiking rates this year. So capital tends to flow where the higher yields are. So with gold and oil pulling back sharply, that's been a driver for the lower Canadian dollar. So as I said, when you're looking at currencies, you need to look at all the alternatives. So with the U.S. dollar, you're looking at the Canadian. Well, we just went over that. Look at Europe. Europe's dealing with accelerating inflation, rising geopolitical risk. Japan, well, that's still navigating decades of loose monetary policy. So the U.S. dollar strengthens not because America has figured everything out, but because when global uncertainty rises, capital seeks the deepest, most liquid, most safe, established safe haven on earth. And that's still the U.S. dollar. And that's by a wide margin. So the debasement story isn't wrong on the long-term basis. But remember, as I say, this debasement is happening to all these fiat currencies. But in currency markets, long-term can be a very long time. And the short to medium term, the dollar remains the world's reserve currency. And that privilege doesn't disappear overnight, no matter how large their deficit is. And remember, it's not just the U.S. dollar with these massive debt problems that are debasing the currencies. Canada, all of Europe, Japan, all having the same issue. So why would you put more faith in the euro or the yen? Long term, I sure wouldn't.
Bitcoin hit an all-time high of $126,000 last October and is now sitting at around $60,000, a 53% drop in just 8 months. What's going on, and what are you watching?
Yeah, Bitcoin, it's very interesting what's happening there. So it hit its all-time high in October, 126,000. And as you say, Jim, today it's now 59,980 actually. So there's that 53% drop. And that includes a nice 38% rally from, I think it was early February, February 3rd to May 13th. But since May 7th, Bitcoin has given all of that rally back. And that's a deteriorating pattern of diminishing momentum. So you got the buyers are losing energy on every bounce. So Bitcoin's testing very critical support here at 59,000. If that breaks, we're looking at about 51.5 is the next one on our models. So now it's getting close to being oversold here, so we could see a bounce in the next little bit. But Bitcoin is not looking good here. This is very key time for Bitcoin. One of the things I've been wondering about is, has Bitcoin lost its glamour? I think we've got this institutionalization has made Bitcoin kind of boring for the younger investors. Wall Street infrastructure has stabilized Bitcoin. So while it remains very volatile compared to the S&P 500, it no longer promises these massive, crazy overnight gains, 100% gains, 500% gains overnight. The returns that generally, originally captivated the Gen Z and the millennials. So I think that what we're starting to see is we're starting to see like the prediction markets. They've emerged as a direct structural competitor to crypto speculation. So you've got on-chain volume data from early 2026 highlighting massive cultural shift here. Predictive markets, they're actually overtook the traditional crypto gambling and that reaching tens of billions in volume. You got platforms like Polymarket that allows users to bet on politics. So we're talking, election outcomes, policy changes, pop culture, global events. So it delivers a very simple win or lose outcome. You're right or you're wrong based on how world events unfold. And you got many younger investors feel more confident judging current events than trying to predict complicated economic or market cycles. So it also satisfies that desire to take, calculated risk without owning a stock, and with all the all the inner workings of that company, are they having a union strike? All of a sudden the stock can go down 20%. And you have no reason, you had no idea what it was about, no company specific thing, but it just went down. So we'll be watching closely to see how Bitcoin does here in the next week or so. As I say, it's getting technically oversold, so you should see a bit of a bounce. But watch that level of the low 50,000 level.
Does decentralized finance play a role in Bitcoin's struggle?
Oh, absolutely. DeFi or decentralized finance. That's the infrastructure that makes things like the prediction markets we just talked about possible. You've got this fractionless trading. So because of decentralized exchanges like Uniswap, investors don't need a middleman or a stockbroker to trade. They can simply swap tokens. They can bet on politics or enter high leverage trades directly from a digital wallet on their phones, and they can do it in seconds. And with DeFi, you also have, the capital vacuum. So you've got this infrastructure that makes the velocity of money incredibly fast. Capital that used to sit quietly, say in Bitcoin, is now constantly flying through DeFi pipelines, chasing whatever the hottest trend of the week is. So if Bitcoin is digital gold, say a store of value, think of DeFi as the entire digital banking and trading system built on top of other blockchains. For risk capital, DeFi provides this massive alternative because it shifts the investor from a passive holder to an active market participant. The logic is, why wait for Bitcoin's price to come when you can become a liquidity provider? You can be a lender, you can be a yield farmer, an open source financial playground. If any of your listeners are interested, we've got our DeFi Digest. It is still a free service. It helps investors who want to learn about this game-changing technology. It covers all the major developments to educate, provide guidance to help subscribers work their way through, the evolution of this, incredibly exciting new financial revolution. Now, the learning curve exists, but if you're someone who enjoys exploring technology and want to get part of the next game-changing revolution, do check out our DeFi Digest. We are still not charging for the service, at least not yet, but we do want feedback as we're trying to make this the go-to DeFi investment newsletter. And if anybody's interested, just simply email us at info@thetrendletter.com.
Yeah, can you remind our listeners about each of your services and how they can get in touch?
Oh, yeah, sure. Okay, we've got 6 services. We got the 3 paid ones. You got Trend Letter. 25 years we've been publishing that. It's a weekly service, comes out every Sunday evening, mostly for long-term investors wanting to understand what drives the markets. So that's $600 a year. It covers all sectors: equities, currencies, precious metals, commodities, and bonds. The second one is Trend Technical Trader, online service, updated every Monday, Wednesday, Friday, mostly for active and long-term investors. It originally was a hedging service, but it also now covers long positions. And again, also covers equities, precious metals, commodities. And it includes our proprietary gold technical indicator. Technical Trader is $650 per year. The third one is Trend Disruptors. So that's for speculators with high risk capital available. Invest in obviously disruptive ideas, AI, virtual augmented reality, cloud, Internet of Things, 5G. And now that one is $600 per year. The free services, there's the DeFi Digest that we just talked about. So again, that covers the development in decentralized finance sector, very speculative. We have Market Pulse. So that's a market recap, highlights key market moves, whether it could be daily or weekly. And then we have Headlines. That's our free daily service. And what we do there is we review every morning what's happening in the markets, and we send the headlines out to subscribers, and the headlines that we think investors should be aware of. And that they're not always, and often not always, front page news. Sometimes they're deeper into the weeds there. And readers can simply read the headline, and if they want more detail, they can just simply click on the link and read the article. And we also have videos, and you just go to our website and click on the video page, and you can just review our latest stuff there. So if any of your listeners have any questions about any of our services or what's happening in the markets, they can email us at info@thetrendletter.com.
Martin, thank you so much for being on This Week in Money.
Oh, always a pleasure, Jim. Have a great weekend.
My guest has been Martin Straith, founder of Trend News online at thetrendletter.com. Our conversation took place on Friday, June 26th. Coming up, Josef Schachter, next on This Week in Money.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Josef Schachter, founder of the Straith.Energy Report online at Straith.EnergyReport.ca. Josef, welcome back to This Week in Money.
Oh, it's a pleasure to be back with you, Jim. Lots going on. Price of oil was 69 when we talked 95 when we talked last month, and 69 today. So quite a change.
Mm-hmm. Now, how can our listeners subscribe to your Eye on Energy and the Straith.Energy Report?
Yeah, they can just go to the website, Straith.EnergyReport.ca, www.Schachter, S-C-H-A-C-H-T-E-R, EnergyReport.ca. There's 2 methodologies, quarterly subscription, annual subscription. Once people get comfortable with, they start usually with the quarterly, then the economic benefit is to go to the annual. So go look at the website. There's some free research from old historic research. You can see how well designed the website is, and I think you'll find that we offer, if you're given energy is so topical, given energy is such a, has been an attractive area. And as we talk and go through everything in our discussion today, I think that we're getting ready for another great buy opportunity, and I think that we're going to see much higher prices in the years ahead, even though everybody seems to be complacent because there is discussions for an MOU. I don't think people realize that that doesn't mean that free passage and that we're not going to see higher prices because the industry's not spending enough money to meet the growing demand.
Now, before we get into the numbers in the energy business, your big energy conference is coming up in October. You're working hard on it. Can you tell us about it?
Yeah, what we found was that not only having good research, but having access to management for individual investors is really something that we've done on our own, and that no one else was doing in Canada. So, last year we had 38 companies signed up. We do it at Mount Royal University. We have this year 45 companies signed up, both in the energy industry of today and the energy industry of tomorrow. So critical minerals and clean tech are in that group, sponsored by the TMX. And what we do is we have sessions of about 30 minutes. So companies do presentations for about 20. There's Q&A. And the other attractive thing we do is we have booths where the senior management are there for big sections of the day, so you can go over and talk to the CEO or CFO of a company you own, which is something that, with virtual AGMs doesn't give you a chance to do. So the two products of both the research and the conference are very supportive of each other and make it for a very unique product. And all of our subscribers get 2 free tickets to the conference. So there's another economic advantage to becoming a subscriber right now.
Joseph, one of the great things about your conference is, just like any good rancher, you like to feed and water the herd.
Yes, we do. We've been one of the things. Some conferences don't have food, and you got to buy it from the hotel or whatever is available. At the conference centers, the big conference centers that are out there, we start with a sponsored breakfast, and then there's snacks in the morning and the afternoon. We put on a very good buffet lunch. And then at the end, when we have the panel at the end of the day, a glass of wine. So it's a very informative day, very knowledge-getting day, but also a very satiated day.
Now, waterfall charts in the price of oil. What are the charts telling you?
Well, if you remember when we were in the mid-'90s, we said that if there is going to be some positive discussion between Iran and the United States, and it looked like maybe they were going to stop fighting and the war would end, and maybe transit would open for the Strait, that we'd probably see the price of oil come down below 75. And now, of course, we're now below 70 at 69.5 or so. And I think there's still a little more downside, but I think we're getting to a very oversold level. The technical indicators are showing it. So sometime in the next week, I think we're going to be sending out an action alert with a number of new buy recommendations, and also reiterate the best of the bargains that are out there. So again, that's another reason for people. This is a very timely interview, because I think people will find some great buy ideas. So again, that's another good reason to become a subscriber at this point.
In the past, higher oil prices have led to higher transportation costs that have led to higher prices for goods. With lower energy input costs, could we see a decrease in the price of goods? I'm
skeptical. You look at whenever you get a price decline, there's always other price increases. If you look, the Globe had an article this week about airlines not reluctant to lower their fuel surcharges. You look at the gas pump. Yesterday we had $1.50 up on the price of oil. We're up 17 cents to $1.69 in Calgary now for a liter of gas, regular gas. And Trump is now banging the table on the oil companies, lower the price, it's down. The reality is they've got a lot of expensive inventory they bought in the last few months. They've got to move that through the system, and until they do, they can't lower it because of current prices. So You've got high cost inventory. You got to get through that before you can see the lower prices that we all want to see. But the U.S. gasoline price is now down below $4 a gallon, so that's some improvement from the $5 number. California is still insane, but that's because of their own policies. So, but in Canada, I think that the prices that you see in your local market that you had during the week that were the lowest. That's probably the lowest you're going to see. Even if we have another $1 or $2 off the price of gas, price of crude, I don't think it's going to lower the price very much. And if I'm right that we have $80 WTI in Q4 and $90 for the average in 2027, because of the supply shortage and demand is going to be there. This assumption of demand destruction is proving quite false.
Could lower interest rates lead to lower oil prices?
I don't think so. The rates are so low that they don't really have an impact on a commodity of any kind, gold or oil.
Sanctions are being taken off Iranian oil, increasing supply. Do you think President Trump wants low oil prices to stimulate the economy and trade?
Oh, I think he wants lower oil prices because, affordability is a big issue in the November elections, and so he's trying to get prices down. And so he needs, the Strait open. Yesterday, I think the data I saw said there were 14 million barrels went through the Strait. That's, not the 20 that it was pre-war, but that's a pretty good number. And then plus Saudi Arabia is shipping oil from, to the Red Sea. So you're getting good volumes, and there was a lot of ships that were stuck. So those are the ones that are coming through. So that's why you see such a high volume. But then you also saw Iran attack a ship with drones, and they said, you have to get clearance to go through the water by us, even though there's really 3 channels, and this is really important for listeners. There's the channel near Oman where the U.S. Navy is protecting ships going out, and that's where the Saudi ships and others that are going out through that. The middle channel, which is the biggest, which is where the mines are, that's where the demining has to happen, and that could take a month or longer, depending upon, the cooperation of the mine placers, i.e. Iran, telling the Americans and plus bringing their own people in, ships to remove the mines. And then you have the channel, which is open by Iran, where they're charging $1 a barrel. So if you have a ship that can carry 1 million barrels of oil, you're charging $1 million. If you have some of the VLCCs with 2 million barrel capacity, you're paying $2 million. So, I think Iran has realized they've got a fabulous way to get a lot of money coming in the door. They didn't do this before the war, and of course, the failure of Trump to realize his goals has given Iran a new, let's use the word, Trump card.
Up till now, do you think the prices of oil have been manipulated?
For day to day, you can see arbitrage or you can see hedgers do things. But I think the real reality is supply and demand. If you take into account 2008, days of inventory came down from, let's say, the mid-80s to break 80. And that was, you were at the tipping point where there was, shortages across the board. And so we saw the price go from, $85 to $147, if you remember that. Normal inventories are around 90 days. I think we're probably around, anywhere between 84 and 86. We need to see the end of June data to get the Q2 data. It's a quarterly report. But I think we're looking at mid-80s. That's why I think we saw the rise of the price, where the price went up into the 110 level. I think we're going to see, people realize that we're not going to restock the SPR very quickly. We're not going to restock inventories. A lot of refineries, don't have product and are not selling, diesel or jet fuel outside of their own country because the countries have said no exports because we're short of the product internally. Don't gouge other people because, again, don't gouge our people. So I think that it's going to be months before we see every country remove any of those export restrictions.
For the first time in 47 years, Iran is no longer a threat to its neighbors in the world thanks to President Trump. In your latest Eye on Energy, you refer to the U.S. surrendering to Iran. Can you explain that?
Yeah, I think that Iran is still a threat to its neighbors. Remember, Iran is trying to get its Western, producers from the western part of the Gulf, Kuwait, Saudi, Oman, UAE, Kuwait, to pay them a toll to get through the channel. They're going to call it an environmental fee or a safety fee, or they're not going to call it a toll. But after 60 days, they're going to be in a position to charge. They'll throw a few bones to Oman of that revenue, but they are a threat to their neighbors. They're going to be an economic threat through the charge. But the fact that they're going to be getting a lot of money means they'll have the ability to rebuild their military very quickly, and then knowing the drones can do what they've done to, the water facilities, the buildings, the office buildings, the military bases, with their drones and ballistic missiles. I think they're more of a threat now to their neighbors than they were before, and the neighbors are going to have to band together to make sure that they can protect themselves against any future aggression by Iran. And Iran is sitting in the driver's seat here. The hardliners won. The IRGC won. There's no talk in the air about restricting them on their ballistic missile program. There's no restriction. There's no restriction on them really their support of their proxies, the Houthis, the Hezbollah, and Hamas. And so I think the problems still remain.
President Trump is putting pressure on the UK to open up North Sea oil. What are your thoughts on North Sea oil? Well,
I think they need to. They have to realize that they do have a lot of potential still, and so I think that that's something that they have to move on. And the Norwegian side is finding a lot of new reserves. And so who says you're not going to find the same to the west, which is the British North Sea? And I remember years ago Canadian companies being very successful, Talisman and others being very successful in the UK North Sea. So I think that with Starmer gone, the new PM, when he comes into place, is going to have to start looking at the economic issues and the climate. Look at the climate changes initiatives in Germany. We're going to close down our nuclear. Now they're opening the nuclear. They were going to close. They closed down all their coal. Now they're opening their coal. Everybody is saying, my people cannot freeze in the cold the winter, and they need air conditioning in the summer. And again, the heat wave that's going on through Europe is proof positive that the climate environmentalists wanting to shut down the fossil fuel industry are going to have to wait for the Star Trek world of all the things of that they talk about in terms of dark emissions and all all that power. It's going to take time for that futuristic world to be here. So in the meantime, we have to do what we have to make sure that your citizens are taken care of.
Yeah, we'll have to start digging up dilithium crystals.
Yeah, you're right on there. I was trying to get that in my head. I couldn't pull it out of my brain.
This week, President Trump confirmed he's ordered a major Department of Justice investigation into oil companies for price gouging Americans at the pump. Higher energy costs hurt the economy. Do you agree with this investigation?
No, we've seen it from other presidents in the past. Biden did it, when prices were high. The key thing is if you buy inventory at $110 a barrel, and then you put it through your refineries to produce the gasoline, jet fuel, diesel, all the things that you other oils, that you need. You got to push that inventory through at the price that's needed to justify it. And it's only when you're buying, $69 oil, which could be 2 months of delivery later to the consumer, are you going to see the big price decline? So I think that he's trying to get them to do it now. Again, it's political. They want to have low prices and affordability, not an issue in November. If the price of gas is under $3 in November, the affordability issue is not going to go against him. People will say, okay, it was the war, it's over. My $5 gas is now $3. I'm happy. I'll vote for the Republican candidate.
Do you have bullish and bearish cases for oil?
Yeah, I do. Let's start with the bearish case. The bearish case is if there is economic disarray, and Trump through problems at everything with his trade war, with his trade taxation. He's now saying I'll charge 100% to countries that put a fee on American technology going into their country. So there's all of that. Which could soften the economy. Right now, the forecast is the U.S. will grow by 2.5% this year, next year, and demand is growing in the States. People don't seem to realize. You hear about demand destruction. Well, the Americans are the largest consumers, and they produce 23.8 million barrels, and they only consume 20.7. So they export, 4.3 million, 4.4 million, and demand in the States is up 3.1 million from a year ago. 20.7 versus 20.1. So the biggest consuming nation, when you have, let's say, 106 million barrels of global demand, the Americans are a big piece of it, and there's growth there. The argument that China is seeing, demand destruction, that's really them not paying high commodity prices. They're very sophisticated commodity buyers, and so not buying because they couldn't get their Saudi cheap oil or other oil cheap. So they use their SPR. Now that that war is over, they can start buying again, and at 69, it'll hell of a lot better than paying 99. So I think that we're going to see China demand pick up again, and I know Iran is trying to sell at a discount because while sanctions have been removed from the States for the 60 days, Europe has not removed the sanctions, so they can't sell to Europe. So it gives India, China, Japan, South Korea, the bargaining handle to get cheap oil into their country from Iran. The bullish case for oil is if we have economic growth, 2 to 4% GDP globally, the industrialized world, the OECD at the lower end, the emerging world that's going to be bringing us the lithium, the copper, the nickel, everything we need for data centers and improving the grid. They're going to use more oil, at the facilities to produce those products, but also the people who are working there are going to want a better standard of living, and so they're going to want electricity in their homes. They're going to want water in their homes. They're going to want better schools. If to get the buy-in from the country's, people, you're going to have to be able to give them a better quality of life, which means more energy consumption. So I think the global demand will be between 1.3 million barrels per year. The industry is not spending enough money more than to grow production by 600,000. That's Guyana, that's the States. The U.S. production, just to give you the numbers, it's up 375,000 from a year ago to 13.8 million, up from 13.4. So the U.S., Permian Basin and the other basins are still increasing. Canada maybe by 100,000, Guyana by 200,000, Brazil maybe 100. You add that up, and if demand is 1.2 and supply is only 600, and there's many countries that have depletion that aren't spending any money, so their numbers just go down. So the net effect of it is that we're going to be short. And, if we start getting, real growth in the third world, that's going to drive prices higher. So I think we're, as I said, at 80 in Q4, which I think, we'll tell everybody that's going to 70, 80 is the new base, but 80 is what's needed for the industry to be incentivized, 90 in 2027. And I think that heading into the later years, into the end of the decade, we're going to be north of 100. But the market never pays for that in the price of stocks. But right now they're paying for maybe $60, $65, given the 69 and given how much the correction has been. The last time you and I talked, There's been a 15 plus to 20% correction in many stocks. So there's bargains out there again, which is why I think we're going to see our buy signals triggered next week, potentially. So that's the bullish case there. And I think we may see spikes when we do see, winter or summer where there's a shortage and inventories are low, where we could beat that 147 that we saw in the summer, June, July of 2008. On the case now for natural gas demand for LNG is going to pick up. It's the cleanest burning fuel. You're going to see more and more LNG in the U.S., Gulf Coast. Qatar is going to rebuild what was destroyed because they have a big basin. Australia's got problems producing. We on the West Coast have got the buy-in even from the BC government and a lot of the First Nations. So natural gas exporting from us to Japan, Korea, China, etc. India is going to happen. Japan is now talking more and more about importing LNG from Canada, and they want to be in not only in terms of the buying, but probably owning facilities and helping to support building facilities, maybe even buying reserves, so they have their own captive reserves. So I think the natural gas story globally is a bullish one. You need large reserves. And Russia has them, but Russia's going to have problems because people are not going to want to deal with them until the Ukraine war is over. And then you have the Middle East, Qatar being the big one, and Iran potentially could, but again that's going to take time. And then you have U.S. and Canada. So and Canada is the one that's just getting its act together. We have 2 BCF a day on from LNG Canada. By the end of the year, we'll might get the FID on the second 2 BCF a day trains. And then we're hearing, the Hysalination one, that's moving forward. The Enbridge one and the Cedars one are moving forward. So there's projects moving forward. And could we have 6 to 8 BCF by the end of the decade? Yeah. And that's a big number when you compare our production at 18 or 19. So that's a bullish case there. The bearish case for natural gas is, again, the recession case, and that people don't, worry that they use more coal because it's a cheaper alternative if the price of natural gas gets too high. They're all talking nuclear, but that takes time and very, very expensive. And there's still the issue of where do you put the rods when they're done? The nuclear waste is still a big issue. So I think that of all the commodities out there, to me, natural gas has the best long-term opportunity, but liquids, oil, crude oil, is also is probably the more profitable business, and so both are the ones you should own in your portfolio. So what we do in our recommendations is we have conservative ones, big companies, strong balance sheets with dividends. Then we have growth, which are companies, some have dividends. Mostly it's a growth story. And then we have entrepreneurial, where the drill bit makes a difference. And if they're successful with the drill bit, you'll have some very good success. So we have clients that are very conservative, older, that want dividend income. And then we have more entrepreneurial people who would like to see something that could be, 5 or 10 bagger, if the companies are successful with the drill bit. So, we try to cover, those 3 bases. We cover, domestic natural gas, domestic crude oil companies, Canadian service companies, and we cover Canadian companies working around the world in the oil and gas business, and there's some very successful companies doing that.
What's the latest on rig data?
Well, the rig data just came out again this morning. Again, remember, this is based on historic, so, prices were in the 90s. Remember, in just 2 weeks, we've gone from $95 to $69. So it'll be interesting to see what happens in the coming weeks. Because when you do these rig contracts, you're doing them for months in advance. So, people might have been assuming that the second half was going to be better. Now at 69, we might see slow numbers in the next little while. But if we get back to 80 in Q4, which I believe we will, or companies take a longer-term horizon, then we're going to see strong rig counts. So the U.S. rig count is up 4.7% from a year ago, 573 rigs up from 547. If you break that down, they have 125 gas rigs working, up 14.7 from 109 last year. And the oil rig count really hasn't moved, 440 versus 432 a year ago, up 1.9. The big increase is Canada, surprisingly well, at 1.4, 70-cent Canadian dollar. We're 197 rigs up from 140, up 40.7. Gas rig count 58 versus 46 again, up 26% again. The whole issue of more LNG going for export. And the oil rig count is up a lot because, again, that 140 Canadian dollar exchange rate, 137 versus 94, up 46%. So our service stocks have done well. They're backing off now because of the lower price, but they have done quite well, over the last, the last few months before the break in prices that we saw just in the last few weeks.
What are your thoughts on the stock markets and SpaceX?
Well, SpaceX has, backed off from that, 200 intraday high. It opened with a big profit for people, but its valuation is insane. The thing I'd concerned about is starting in August, a lot of the insiders, have the restrictions removed. Even more so in September, I believe 40% of all the stock owned by employees and insiders will be released by then. So that'll tell me that when you tell the tale, what is the stock worth and what people are willing to pay. Right now, because of it being allowed into the NASDAQ, a lot of the index funds have no choice but to buy the stock because of the size of the company and the index weighting. But I think the tell will be when you see what happens when the insider releases occur.
Any thoughts on the U.S. and Canadian dollars? With
$69, dollars on WTI, the Canadian dollar is very weak. But if we see, the $80 averaging in the fourth quarter and 90 in 2027, I think the Canadian dollar could go to 75, 78 cents from 70. So I think the Canadian dollar is cheap here. And I've had some people asking me, hey, if I took profits a couple of weeks ago when you said take profits, should I move my U.S. dollars into Canada and buy Canadian stocks? And my answer is a resounding yes.
Is the growth in electric vehicles likely to be bearish for the price of oil?
Well, it's got to be for the right. There's two things. One is technology. If they can get the batteries to work in our temperatures in the winter, so that you can go between Calgary and Edmonton without charging in Red Deer, or stopping because your power is gone. That's an issue. Technology resolution for cold climates. But I think the cost of a battery charge is much lower than a gasoline charge or diesel charge. The problem is at some point the battery is charged doesn't hold and you have to replace the battery. So you have a major expense down the road. Is it 5 years, 7, 10 years where you need to replace the battery? That's a big expense. So I think EVs are here. I think the technology still needs to improve. But I think that, the fact that the Chinese companies are being allowed into Canada, under the new agreement, and more so as time goes on. And, of course, the Americans are getting better at making EVs. So I think EVs for cars, trucks, for in-city use will definitely rise. For me and my wife here in Calgary, we both have, gasoline, premium use gasoline cars, because we need, something to go on the highway to go up and down to Edmonton to see family. And, if we did get an EV at some point, it would be down the road when both of us don't need cars and we get one car for us to use. But that for people in Alberta and people in where there's long driving distances to go to cottages or to go up go between the two major cities, I think it's less likely. In city use is you see a lot of Teslas in Calgary.
Some people are thinking Canada will become the 51st state. Would that be good for the oil and gas industry in Canada? From a regulatory basis, dealing with the federal government, might be better for the oil industry. But I don't think, the oil industry is, I don't believe we're going to be the 51st state. Look at our population, look at our size of our country. It would probably be the 51st to the 60th, 9 states, just because of the size of our country. So I'm skeptical.
I think that, the separatists are using it as a way for Carney to have leverage, and also for our premier to have leverage with Carney, and then leverage with the U.S. It's just like anything, you need to have arguments, in favor to get you what you want. And, of course, Alberta wants more support for major projects. This pushes Carney. And then, of course, Carney needs to see the economy grow so he can pay off that $1 trillion deficit and massive annual deficits. So he needs to see the pie grow, which means, mining, forest products, energy, anything that, precious metals, anything that can be an exportable commodity. We're not an industrial, powerhouse. I think, Shopify, we've had Nortel in the past, we've had BlackBerry or RIM in the past, but we've never had it to the point where it was a very high, usage of manpower and employees and impact on the economy. So I'm skeptical.
Where can our listeners find out more about your upcoming conference and subscribe to the Schachter.Energy Report and Eye on Energy?
Yeah, they can just go to our website, www.Schachter.Energyreport.ca. It'll have in there that every new subscriber gets 2 free tickets to the conference. There's also a lot of information on the conference and our Eye on Energy that we put out weekly on Wednesdays. So people are getting a lot of product. We do quarterly webinars as well. And so that plus the conference, it's a pretty, total package for people wanting to be invested in the energy industry. And our Eye on Energy is considered one of the best macro pieces in the country. And even we have a large network of Americans and people all around the world now because we went on Substack. So we've had 60% growth in subscribers over the last 9 months, and over half our subscribers now are international versus 90 or 95% a year ago being Western Canadian.
Joseph, thank you so much for being on This Week in Money.
Oh, my pleasure. It's great to be with you again, and hopefully we'll have some exciting things to talk about at the end of July.
My guest has been Josef Schachter, founder of the Schachter.Energy Report online at Schachter.Energyreport.ca. He was speaking to us from Calgary. Now we skip up the highway to Edmonton to speak to Hilliard MacBeth next on This Week in Money.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Hilliard MacBeth, author of the second edition of the book, When the Bubble Burst, Surviving the Canadian Real Estate Crash. His website, MacBeth.McLeodPartners.com. He's speaking to us from Edmonton. Hilliard, welcome back to This Week in Money.
Nice to be back. We got a sunny day here in between a huge rain storm last week and another one starting tomorrow for Edmonton.
The latest edition of your book, When the Bubble Bursts, is on sale now. Can you tell us about it and where our listeners can buy it?
So the second edition of the book was written in 2018, and it's covering all of the issues that are coming to light now in Canada in terms of problems with lending for housing and the drop in value of houses and condos. And people can buy it at all the best bookstores and online and Kindle and Kobo and all those things as well.
Prime Minister Mark Carney and Housing Minister Gregor Robertson were in Vancouver recently to announce a $3.2 billion bailout targeting mainly a Liberal Party supporting developer. It involves 2,200 dog crate-sized condos. When governments socialize losses like this, mainly for a specific developer, is it a red flag for the rest of the Vancouver housing market?
Well, I think it shows that there's a real problem with unsold condos. The developers are sweating in. Now, one of it's blown up on X. There's people should check out. They can check out my handle HMACBE on X, and there's literally hundreds of comments. And one prominent commenter said that maybe it's a bailout of the banks, not the condos, because of course the lenders are stuck if the developer walks away from the condo building, or if the people who bought the condos in advance can't close on the deals, which obviously is happening. it can ripple back through the lending community. But I'm a little bit skeptical of that explanation because the banks, the Canadian banks, all 6 of them are up an average of over 60% so far this year. So that's excuse me. So that's unless the market has really got the Canadian banks misvalued here, it's unlikely that it's going to ripple back into the lenders. But the developers are in trouble, and it happened in the 80s in Alberta and elsewhere in Ontario as well. And when people tried to do this thing where they would buy up the units and convert them to rentals, it's a nightmare. Basically you have to buy up the whole building because you can't have some renters in there and some owners in there, and it becomes very complicated as a condominium building. So you basically have to buy out all of the owners, plus the defaulted owners, plus the developer still owns a bunch of units, and especially in Vancouver, many of the owners might be offshore in China or other countries. So it becomes a nightmare to get it converted. You got to get 90% of the units, at least under Alberta law, before you can force a conversion into rentals, and the remaining few owners are forced to convert. But I don't think they thought it through. They didn't think this policy through very carefully when they announced it. Now it is a part of a bigger $3.2 billion plan. The buying the condos part of it is sort of coming out in dribs and drabs. The announcement was very poor. It didn't really explain what was really going on. It looks like it's about $1.5 billion, but 2,200 condos, somewhere between $1 and $2 billion, depending on what condos we're talking about. But the other issues are even more important, I think, and that is why not let the market decide? Let's force the developers to sell these condos at a loss, because right in the announcement it said the condo developers are reluctant to sell at a loss, so they're maintaining their original price, which is complete fantasy now. The prices have gone way below that. Well, why not force the developers to sell at a loss? And that's where the lender might get involved, because the lender might say, well, if the actual real price for that condo unit is 30% less than what you're telling us, then we're going to call our loans, or we've got the right to step in and force some sales, that sort of thing. So there may be a lot more to this than it appears, and if it's true in Vancouver, for sure it's true in Toronto, because Toronto condo prices have come down even more than Vancouver prices. So, and there's instead of something like 5,000 or 6,000 units like Vancouver has, in Toronto it would be 20,000 or 30,000 units. So it's an interesting reaction to an announcement by the government that was poorly thought out, and both the socialists and the capitalists hate it. The capitalists hate it because just let the free market decide what the units are worth. Don't step in and try and support a falling market. And the socialists say, well, you're building out the developers, the people who made all this profit from Vancouver real estate, and you're just making the taxpayers pay. And then, in other words, you're privatizing the profits and socializing the losses. So both sides of the political spectrum are quite upset about this. So they're going to have to amend what they announced, I'm pretty sure, before this is over.
What is real estate doing in the rest of Canada?
Well, there are some small pockets of positive. Saskatchewan and parts of the Maritimes. Quebec's doing quite well, actually, surprisingly. But the big markets, of course, are Toronto, Vancouver, Calgary, and there's weakness, especially in Toronto. Toronto's, I think the average price now is down 30%. So you're talking about $1.5 million home being worth $1 million now. And even those homes are sitting on the market at $1 million. The sales are really slow right now. So we don't even know if the 35% off is the bottom. It could be. And some power of sale, like foreclosure sales, have come in as much as 50% below the previous peak price, which was in 2022. That's in Toronto. Now in Vancouver, we got this problem with these unsold condos. These are brand new condos that are sitting on the market. There's thousands of them apparently, which is, when you figure an average building might have 200 units in it, you're talking about a bunch of high rises sitting unsold. And So that's a big problem. And then in Calgary, it's more single family oriented in Calgary, but there are signs of some cracks in the pricing there as well. So it's overall prices have been going down. Prices have been going down pretty steadily since 2022. If people want to look on my X account, every month around the middle of the month, we publish a chart with house prices, average for Canada, Toronto, Vancouver house prices, the household debt, which has been rising steadily throughout all this, and things like inflation and average after-tax income. And it shows very clearly there that the prices have been coming down for about 4 years now. So it's a big deal. It's happening, and it's still, we're probably in the third or fourth or fifth inning of a 9-inning baseball game, but the last innings are the most exciting. If you're waiting for excitement, you tend to come up towards the end.
Prime Minister Carney gave title to most of Metro Vancouver to the Musqueam Indian Band. Other bands say it's their land and they plan to sue. Hearing this uncertainty is now affecting the commercial real estate market. Is residential real estate likely next?
Well, it depends, where you are. I've talked to a number of entrepreneurs that own property in BC, and the rumor is that there's going to be a one-time 4% tax paid to the original landowners, the indigenous people. But who knows what's going to happen for sure. It's going to drag out for years. There's only been one court case, and there's now a bunch of other issues happening. So, and on the other side of the coin, Prime Minister Carney is pushing for pipelines to be built to the West Coast, which go through all kinds of land that doesn't have proper title to it, other than indigenous title. So it doesn't have title that can be easily dealt with. Let's put it that way. I didn't mean to say proper. I meant title that it might be in doubt. So there obviously is plans to move ahead in spite of the questionable title in some parts of BC, but it is affecting people's decisions. One owner on Salt Spring Island sold his property there just because he's worried that something's going to happen. And it may never happen, but people start to think that way, and they make decisions to sell. And by the way, he didn't get anything near the price that he thought he was going to get on the sale. So used to be on Salt Spring, you'd wait for years just to be allowed to buy something at a huge premium price, but nowadays apparently the market's not like that anymore. So,
are some homeowners who bought since 2020 seeing the amount of their mortgage exceed the current value of their homes?
Yeah, this is the classic upside down on the mortgage, and definitely there's thousands, if not hundreds of thousands of Canadians there now, and likely to be 1 million or more at some point. There's about 10 million households in Canada, maybe 12 million now. About 70% of them are homeowners, so let's say 7 or 8 million. And there could be as many as 1 million that are in that position. There's the ones that bought in 2022. They're for sure already underwater on their mortgage. But prices have come down to the 2017 levels in some parts of Greater Toronto area. So there would be a bunch of people that bought many years before 2022 that are now at that point. But the other thing that happens is people are refinancing mortgage. Of course, in Canada, unlike in the U.S., in Canada, mortgage rates come up for renewal every 5 years, and people, when rates were kept so low from 2010 till 2022, the rates were kept extremely low, close to zero. The temptation was to refinance your mortgage and take out some of that equity. There was the one bank of Nova Scotia had a whole marketing campaign on based on that one thing, which is the campaign was you're richer than you think, and you've got all that untapped equity in your home. And it wasn't just that one lender that was doing it; all the lenders were doing it. So people would take out. We used to call them second mortgages. It was a real negative thing. Now they're called lines of credit, and it's a very positive thing. Take out a line of credit to buy another property, or to do a renovation, or to go on a bunch of, once in a lifetime holidays, and all of those things were increasing that debt. We could see clearly on the chart that we produced, household debt has kept climbing through all of this. So with all of those other people, they could easily, their home could have risen in value, could have doubled in value since say 2010 or something. But they could still be in trouble on their mortgage if they took advantage of the offers to borrow money against it and take a fling somewhere.
In Japan, home prices peaked in 1991 and bottomed 10 years later in 2001, down 70%. How does the Japan experience compare with what Canada is going through now?
Yeah, it's I haven't heard it described that way before. When I wrote my second edition, I put a whole chapter on Japan in there, and it was actually 25 years. So that maybe 10 years to the bottom, but 25 years to the point where the recovery had gotten back to where it started, and in some places, not even still today is it back to where it started in 1989. So the peak. So, but it's different in Japan. So they don't have a culture there where people were flipping homes. Homes would stay in one family for 100, 200, 300 years. And there were very few transactions. So the calculations that are made on land values in Japan are basically, and housing values, are basically based on the value, the price of land in major cities. It's really hard to determine the value of houses when they never trade. So it's different there. They're not used to a culture of like we have, of flipping homes and that sort of thing. But it does show that when you have a speculative bubble, they had a bubble not just in real estate, but they had a bubble in the stock market. The stock market in Japan is I don't even think today it's back to where it was in 1989. So they had a bubble in everything, and the thing was that the government was instructing the banks to lend freely and lend aggressively, and they did. And in fact, the one book that was written on it indicated that the central bank would call the banks and give them a quota as to how much they had to lend, and they were required to lend that much, or else they were going to be in trouble. So they had to find things to lend to, and of course, land is a classic item that people love to use as collateral. So it was a major bubble for many reasons in Japan. In Canada, the banks are involved a lot in residential real estate lending. Which wasn't true back in the early 80s, by the way, but since the 80s, the banks have taken it over primarily. So now we don't know. We haven't had a downturn in residential real estate since the banks have become the major players. So there was a downturn in 1990, but still in 1990, even though the banks had started to take it over, it was still a lot of trust companies, a lot of mortgage companies, that sort of thing. And as the trust companies and the mortgage companies went bankrupt, the banks took them over. And National Trust, Royal Trust, there's a whole bunch of trust companies that got overextended on real estate in the 80s and the 90s. So it's the banks have brought stability to the sector, but they also may have made it people too complacent about the situation. So we might be in something similar to Japan, but it's probably going to be quite a bit different here too. And we don't know yet how long it's going to take. But I think if you use the Japanese time scale, we're in early days yet. We're 4 years into a 10 or 15 year cycle.
Home prices peaked in Vancouver in early 2022. At that time, the average detached price was approximately 18 times the average household income, and the average detached price was approximately 26 to 30 times median household income. How many times income is the average detached home likely to be when the market bottoms?
Well, Vancouver shows up. There's there's a report that's put out every year called Demographia, and those statistics might be from that. It showed when I was writing the book. Now that's 8 years ago now. I believe Vancouver was the highest in Canada, and it was right up there with Sydney, Australia, as one of the highest in the world at around 10 or 11 times. And so I did some research, went back to prior to the forming of this bubble. This current bubble in Canada started to form in the early thousands, so around 2000, 2001. And prior to that, the house prices generally are around 3 or 4 times at peak, and they were often below that. So in the 80s, after the crash, when interest rate went 20% in the 80s, and housing prices crashed everywhere, it was well below 3 times household income. So for it to be at 20 times or 10 times, it's just crazy. And for it to get back to 3 times income, which was the previous peak, prior to this latest speculative binge, prices would have to come down more than 50%. And it's hard to imagine that. I did mention earlier that prices in Toronto are down 30%, and some prices are down 50% in the case where there's a foreclosure sale or something like that. But we're not anywhere near getting it back to 3 times income. The average home in Toronto, which is now around $1 million, I mentioned, down from $1.5 million, would have to come down to about 500,000, another 50% from where it is now, to get to 3 times household income, which is around 100,000. So that's got a long ways to go yet.
The Dow keeps hitting new highs. The S&P 500 and NASDAQ are lagging behind. Do you think the Dow will pull them up?
Well, there's only 30 stocks in the Dow, and it's not as tech heavy as the NASDAQ and the S&P 500. So that's why the Dow is quite a bit different from those two. Of course, the S&P 500's got 500 stocks, and the NASDAQ, I don't know how many. There's the NASDAQ 100. But there's been a big correction in software stocks, and that's pulled some of those other indexes down. But interestingly, the Canadian bank stocks, I mentioned them earlier, are up 60% so far this year, and they had a good year last year too. So the U.S. stock market is actually lagging the Canadian banks, and the Canadian banks are the biggest segment in the Canadian stock market, the finance sector. So there are other parts of in the world, other places in the world where the stock market is doing even better than the U.S. The big question in the U.S., of course, is what happens with AI and with some of the companies, the big companies that are involved in AI. Not just the NVIDIA, which of course is the most expensive stock in the world at $5 trillion, but other ones like SpaceX, which is now an AI stock, and Tesla, and Amazon, and there's a bunch of companies like that, and some of them have really started to correct. So is the AI boom over? I don't know. It's hard to imagine. There's 2 more stocks to come out as IPOs. They did SpaceX a couple of weeks ago, and the next one is probably going to be Anthropic, and then OpenAI. OpenAI is wondering if they might delay it till 2027. So might not be room for all 3 of them to do their IPO in the next few months here before the end of the year. So, but I suspect that if those IPOs go ahead, the market will probably get a certain amount of excitement, and they may drag the market up even higher for a few more months. But I've thought for some time now that we're getting close to the end of this speculative bubble in the stock market, and it definitely is a bubble. It's as big a bubble as we had in 2000 or 1929, according to some older and wiser observers like Jeremy Grantham, which you can look up on the internet if you're interested. He's calling this the biggest stock market bubble of all time.
What's happening with the U.S. and Canadian dollars?
So the U.S. dollar, people were calling it for, and we even talked about this a few months ago, I think. The Canadian dollar was going to be left behind, and it was going to become irrelevant, and gold got up over $5,000 an ounce. Now it's down to $4,000 an ounce. and the U.S. dollar's gone up by a significant amount. So the demise of the U.S. dollar was premature. The warnings of a demise of it, but it is still a weak security currency, I think, because the Iran war, which we haven't talked about, but it is a turning point, I think, for the U.S. in the sense that the military might that the leaders in the U.S. keep reminding everybody they claim to have has been shown to be not as strong and not as powerful as people thought. And we're seeing it too in Ukraine, where the drone, about 70% of all the damage in that war now is caused by drones, and Ukrainians are world leaders in producing drones. They only cost a few $1,000s, and they're holding back the big Russian Empire with that. So the type of military it's a very centralized military in the U.S. It's a very, of course, nuclear weapons are at the core of it, I guess. But if you rule them out to be used, then some of the other stuff that they have may not be up to current standards. So it's the Iranian military excursion. Not supposed to call it a war, I guess. Showed that the Americans aren't as powerful as we thought, and I think a lot of the strength in the currency was based on safety. People would buy U.S. Treasuries and other securities out of safety, and they also speculated in the U.S. stock market, which brought money into the U.S. dollar. And also, it is still and was used as the trading currency for the largest trading item, which is crude oil. Trading in the crude oil is the biggest dollar value international transaction, and it's always up until now been based 99% on the US dollar. Now about 20 or 30% of the trading has moved into other currencies, led by China, I think. So things are changing rapidly for the US and for the US dollar, and you think about World War I and the Austro-Hungarian Empire up until 1916 was a huge thing, and within a few years after the First World War, it no longer existed. So things can change rapidly, and so there's no way to really predict what's going to happen with the U.S. dollar. So the way to defend against possibilities is to diversify and diversify outside of the U.S., outside of North America, for that matter, into other stock markets and other bond and currency investments as well.
Canada is the only G7 country in recession. What do you think caused this?
Well, it's it's a technical recession, right? We're not supposed to call it a recession. We're supposed to always use the word technical. It's basically a decimal point, right? 0.1, 0.2, 0.1, 0.2, the difference between a recession and slow growth. But it is 2 consecutive quarters of negative growth. So that is the recession. And in fact, it's actually out of the previous 5 quarters, I think it is, 4 or 5 quarters, there's only been 1 quarter of growth, and the others have been all negative growth, small negatives, but negative growth. So that's the problem with recessions. We don't find out we're in a recession. So you got to have 2 quarters so that's 6 months, and then the numbers don't come out for another month or 2. So that's 7, 8, 9 months before we find out that we actually entered a recession 9 months ago. And today we don't know if we're in a recession now or not in Canada. The housing market is a big part of Canadian economy. Construction of residential housing is a huge part. If it's true that all of these unsold condos have caused construction in Vancouver and Toronto to grind to a complete halt, then that's got to show up at some point in the numbers. And as they finish up buildings that they started 2 or 3 years ago, and they don't have another building to move to, then it'll be a recession. So far we've got some signs of it in the unemployment numbers, but they haven't. In a recession, normally unemployment goes to 10%, 11%. Real recession, and in Canada we're around 6.5%, 7% for most of the country. So it's not there yet, but if it comes, it'll be a surprise, and it will be more than just a technical recession.
What's causing food inflation in Canada?
Well, I don't know that. That's this whole thing about inflation is quite interesting. We and I've been involved with it for too many decades to count. But we always were taught that the Bank of Canada moves in and lowers interest rates, and raises interest rates, and restricts the supply of money, and too much money chasing too few goods is the cause of inflation. So restricting the supply of money will stop inflation. But there's another kind of inflation that we're discovering now, which is called supply side inflation, which means there's just maybe a bottleneck in the supply chain, or a shortage, or any kind of thing like that, like a war with Iran, or any kinds of disruptions in Venezuela. Now that wouldn't necessarily affect food in Canada, but one of the things that happens when inflation, like we had in 2022, 2021, 22, 23, gets up to 10% levels, is people take advantage, because the consumer becomes somewhat immune to jumps in prices, and people like to take advantage of that by saying, well, I got to raise prices 10%. It's inflation. There's nothing I can do. Well, that may or may not be true. They might be just raising prices because they can get away with it. So I don't know what's causing the inflation in food, but you wonder sometimes if, especially given in Canada, we've got a very concentrated supply chain for a lot of the major food items, so it would be up to 3 or 4 companies to decide if they should raise prices, and if they're all raising prices, then there's not much we can do. We can complain, but it's not going to change very much, I don't think.
Oh, I don't think the Carney government helped food prices when they just put a 10% tariff on canned vegetables. Yeah,
I mean, there's tariffs, and I don't think that tariffs are a big item on food, but there are a lot of bones of contention. The CUSMA, the Canadian, U.S., Mexico trade agreement's coming up for renegotiation as of the middle of next week, July 1st. And now, of course, it'll take much longer than a week to negotiate. It'll take months, if not years. And the agreement is designed to go for 1 year at a time if we can't come to an agreement. If they can reach agreement, it'll be extended to 2036. So it'll be extended for 10 more years. If they can't reach agreement, then it's designed to roll over every year, and they keep negotiating. And you can also pull out of it with 6 months' notice. So, a lot of people are not very optimistic that the U.S. is going to give us an agreement this time. The president of the U.S., Donald Trump, says that the U.S. doesn't need anything that Canada provides. As an Albertan, I always think, well, why don't we just stop sending them 4 million barrels a day of oil, and maybe they don't realize they're getting that much. You get 20% of their supply of oil from us, but they could probably replace it elsewhere. So that's the risk of doing that. So, but one of the big items of contention in the negotiations, of course, are the marketing supports for certain food like dairy, and so it's going to become a big issue here in the next few weeks, probably.
Iran's been a problem for 47 years. So far, it looks like President Trump has successfully removed the threat of Iran. Does this cause some markets to turn bullish and others bearish?
Well, it's a good question. I mean, all they have is a memorandum of understanding, which is an agreement to discuss, I guess. But the president is in a bit of trouble over the Iranian agreement, if you call it that, because it appears that all of the wins were on the Iranian side and very few of them were on the U.S. side, other than maybe getting the war behind them. And of course, the government is looking at the midterm elections, which come up in November, so it's getting very close to that. People don't think about the elections in the summer, so basically September is when they start thinking about it. And he doesn't have a lot of time to make that issue go away. And, but on the bullish side, the price of oil now is down to $69 a barrel on Friday as we speak here. So it's come all the way down from more than 100 down to 69. So obviously the oil market thinks that the conflict is over. It's basically back to where it was before the conflict started in late February. So I don't know if it's bullish or bearish for the markets. I think it's interesting how 1979 in Iran, Jimmy Carter. Now, of course, in 1979, Iran took a bunch of hostages and held them for more than a year, which basically ruined Carter's chances for re-election in the 1980 election. Ronald Reagan beat Jimmy Carter, so Jimmy Carter only had one term instead of two terms. But and here we are again. The Iranians are having an impact on not a presidential election, but a midterm election. So I somehow I don't think it's over yet. The Strait of Hormuz, this whole new lever that they maybe they didn't even know they had it, which is the ability to close the Strait of Hormuz. And there isn't really anything the Americans can do to get them to reopen it. It gives them some levers that they didn't have before. So, but it probably is mostly over, I would think. These things seem to go away and something else takes over the news cycle. But you wonder if the price of oil is going to, is not going to come all the way back down to $50. It might go back up to $70 or $80 because there'll be a lot of demand for oil to go into storage because people won't want to get caught again. China came out looking brilliant because they had a massive amount of storage, but some other countries struggled with the cutoff of oil from the Strait of Hormuz. So everybody's going to want to have a storage bin full of oil, having lived through this crisis this time, and that could keep the price of oil trading at higher prices for quite a while.
Is the sudden growth of AI data centers likely bullish for the lithium sector?
Yeah, the new battery technology, CATL is a Chinese, of course, it's a Chinese company. Probably don't even have to say that. The world leader in batteries is Chinese. And other companies besides CATL are exploring new methods of battery storage. But battery storage is huge. I mean, they're still building natural gas-fired peaker plants, and the government of the United States really wants people to do that instead of building solar and battery. But solar and battery is taking over really a lot of the growth in electricity production because, originally people said solar, the sun doesn't shine for half the day or less. So it's not enough. But with the advances in battery storage, it's almost gotten to the point now where people can cover the whole day. The peak hours go from 5 p.m. to 9 p.m. There's a wide availability of batteries now that can handle that 4-hour difference between the peak solar and the peak demand for electricity. And everybody just has to shut off their TV at 9 p.m., which would be probably a good thing. But no, I mean, batteries are the ramp for batteries is long and wide and curves to the upper right corner of the chart for probably decades to come. And now the only question over lithium, because you asked about lithium, is there are other battery technologies. So one of the big ones, a huge announcement recently. I forget just now where it was, but it was a very big battery storage announcement. They're going to use an iron rust-based thing. So as a metal rusts, and then can be restored back to pre-rest condition is a way of storing electricity. Now, I don't understand it, so I can't say much more than that. It seems almost too good to be believed. But this announcement was a huge amount of battery storage for a grid application, and things like that could, for the AI, they need an enormous amount of electricity for these AI data centers if they all get built, which they may not get built, but if they do, a lot of them will probably end up being converted to solar and battery, because the natural gas peaker plants are way more expensive than solar plus battery.
Do you think AI data centers are being built for the surveillance state?
I don't think so. I don't know, but I think the AI data centers are being built because if you're in that sector and everybody else is racing to get ahead in the AI sector, even if you don't fully understand where it's going, you don't want to be left behind, right? So you can imagine the board meeting and everybody sitting around saying, "Well, we're getting left behind in AI. What are we going to do?" Well, what do you do? Well, you buy chips from NVIDIA. Well, obviously they've done that. They made it the most valuable company in the world ever, $5 trillion. So you buy a bunch of chips, and apparently a bunch of these chips are not even being used yet. They're in storage because everybody just bought as many as they get their hands on. Elon Musk, for instance, has way more NVIDIA chips than he needs right now. So then the next second thing is, well, we better start putting these chips to work. So we'll build some data centers and put some NVIDIA chips in them. And then the third thing is figuring out what the data center is going to do. And that's the step that's coming next, and they're not quite there yet. So they're racing to get ahead in a race that they don't even know where the finish line is. But China, again, keeps coming up, whether it's electric vehicles or even currency or data centers, they have an advantage that they have 1.2 billion or 1.3 billion people. And a lot of the work that these data centers do is to figure out algorithms and large language models that can be used for other applications. And the more data you have to feed into the data center, the better algorithm or the better model you get. And Chinese have a wonderful advantage there because they've got more people, way more people, like 4 times as many people as the U.S. And they also don't have to worry as much about privacy laws as the U.S. does. So there's already a lot of conflicts about people objecting to having their data used to be fed into these data centers to get a better algorithm for somebody to make a bunch of money off of in Europe. And especially in Europe, but also in the U.S. So in China, they don't have to worry about that so much. So they've got the data and they've got the people to make the next algorithm. And they also have, actually, interestingly enough, something that could cause a problem for these data centers, and that is that they've got a much cheaper method of doing AI. There's a couple of startups in China that are showing great promise at a tiny fraction of the cost of what Anthropic and some of these other people are doing.
Former Fed Chair Alan Greenspan passed away on Monday at the age of 100. What do you think his legacy will be?
Well, I mean, he was called the Maestro. Now, the reason he was called the Maestro was because he lasted so long, and up until the end of his tenure, his tenure ended just before the global financial crisis started. So a guy named Ben Bernanke took over, and then the crisis happened. So Greenspan doesn't get blamed for the crisis, even though he was there from 1987 to something like 2006, I think it was. He's the longest serving Fed chair. So, but what I remember him for, I don't know what it'll be remembered for if he's remembered, but what I remember him for was shortly after, like he got in April of 1987, and I was a stockbroker, and at the time, and he raised rates several times. In fact, I don't know how many times they raised rates, but I remember in September of 1987 being able to buy U.S. government bonds at 13% interest, if you can believe it. You know, everybody knows that in 1981, interest rates hit 20%, but I don't think most people don't remember that they actually went up after Greenspan kept raising rates in 1987 up to 13%. And in October, we had the stock market crash 20%. The Dow Jones crashed 20% in one day. And so Greenspan was only not even like something like 6 months on the job. And the market crashed 20% one day. And we went into, it was on a Monday, and we went on to work on Tuesday morning. As a stockbroker, we didn't know if the market was even going to open Tuesday morning. It was down 20% the day before. In those days, you didn't have like the overnight markets like you have now, so you're just trying to guess where it's going to open. But everybody thought it was going to open a lot lower. And then Greenspan came in and just phoned all of the Wall Street banks after he got a phone call from the White House the night before that said, you have to do something, do whatever you have to do to stop this. So he just said to all the Wall Street banks, you can borrow as much money as you want from the Federal Reserve. Don't worry about it. Just take the money. And so of course they did. And the market turned around, went back up. And by the end of the year, it was up higher on the year than it started the year at. So he solved that problem. Now the problem is he created a new problem, it's called the Greenspan put. And what it is means ever since he did that, all the traders and speculators have sort of have in the back of their mind that the Federal Reserve will always step in to bail them out if there's ever a 20% drop in the market in one day. So he created an unfortunate situation where there's a tremendous complacency in the market that there will always be a bailout, kind of like unsold Vancouver condos. You know, there's always a bailout. And it doesn't help markets to have that cushion underneath them. It's better for markets to be allowed to go up and down. It's not much of a stock market if all it ever does is go up.
Do you think EVs from China could destroy the North American car market? And I'm just taking a look at Europe, where Volkswagen has closed 4 plants and laid off 100,000 workers.
Yeah, so Volkswagen is a really good example to use. So Volkswagen and Toyota were the two leading. You know, you're talking 10 million cars a year at the peak, right? So Volkswagen in 2020, the CEO of Volkswagen, this guy named Herbert Diess, he brought in Elon Musk to talk to the top executives in the company, and he tried to convince these German guys that electric was the way to go. And here's Elon Musk and electric cars and all that. And a couple of years later, that CEO got fired, and a guy named Bloom came in, and he promised to keep the diesel and petrol-based vehicles in Europe as the core business of Volkswagen, and just EV was kind of like a sideline that they would dabble in. Now, Volkswagen is the leading seller of electric vehicles of all of the European manufacturers, actually, not just the German ones in EVs. But they're falling way behind the Chinese ones, led by BYD and of course Tesla, which Tesla has a plant in Berlin. And Tesla also makes Model 3 and Model Y in Shanghai in China. So right now, BYD is expanding. It's going to put a flash charging network across Europe, something like 3,000 charging sites. And those flash chargers, now they only work with BYD batteries. They'll take a car from 10% charge to 70% charge in 5 minutes. 5 minutes. And Tesla's expanding its rapid chargers. Tesla's already got 1,500 chargers across Europe, and they're going to probably double it. And they seem to be able to move fairly quickly with charging stations. So within a couple of years, you're going to have a huge networks of chargers all over Europe. But the big thing is that for Volkswagen is that the petrol costs in Germany are 9 to 10. If I convert it to U.S. gallons and U.S. dollars, it's like $9 to $10 per gallon, and so an EV car is way cheaper in Europe and in most parts of the world than the other ones. So it's cheaper to buy initially. The BYD Seal, the basic sedan, costs about 35,000 euros in Europe, and the Tesla costs about 41,000 euros, but the operating costs are way cheaper. So it's happening. It's happening much more rapidly than Volkswagen thought. That CEO that got the job after they fired the guy, he's the guy that had to announce 100,000 layoffs, and that's about one of every 6 people working for the company, and probably a bigger percentage of the German workforce. Now, the unions are so strong in Germany that it'll be interesting to see what happens when they start actually fighting it out over which plants get closed. But he's announced it, 4 plants, 100,000 workers. So, and they may try and bring in protections against Chinese cars and protections against EVs. I mean, they can tax them, and there's a bunch of stuff they could convince the government to do to slow it down, but there's no stopping it. All you can do is, and the same applies to Canada and the U.S. There's very little, in Europe already, EVs are in the latest figures are at like 23% of all cars sold, pure EVs, and hybrids are another 30%, so close to 0.5% if you count half of all the new cars sold are now got an electric drive in them of some sort. In Canada and the U.S., it's less than 10%. So Canada and the U.S., because of the huge tariffs, and they've been able to stop the rapid transition to EVs. But you can't. All you're doing is delaying it. You're not stopping it entirely. So it's because the operating costs are lower, and also the initial purchase price now is competitive, more than competitive in some cases. With and these Chinese cars, you'd expect them to be poor quality or not have all the features that you expect from GM and Ford, but actually they're just as good, if not better. They're better on the technology actually than the Detroit vehicles. But they don't have a truck. So as long as people keep buying Ford F-150 pickup trucks, Detroit will still be around.
Hilliard, where can our listeners follow you and buy your book?
They can buy my book, as I mentioned, at all the major bookstores, plus the e-book versions on Kindle and Kobo. And a good place to follow me right now is on X at HMACBE. And there's some big discussion going on there right now about the electric cars in Germany and the layoffs, and also a even bigger discussion going on about the bailout of condo developers who have unsold units in Vancouver and Toronto. So we're having lots of fun right now on X.
Hilliard, thank you so much for being on This Week in Money.
Thanks, Jim.
My guest has been Hilliard MacBeth, author of the second edition of the book, When the Bubble Burst, Surviving the Canadian Real Estate Crash. His website, MacBeth.Partners.com. You can find him on X at HMACBE. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Martin Straith, Josef Schachter, and Hilliard MacBeth. And thank you for listening. If you have any questions for the show or for our guests, you can send them to info@howstreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen.